Welcome to this episode of Brand 3D webinar. Today, we're going to be talking about leveraging in business. So it's leveraging on credit and external finance for business growth. And my name is Fiona Tatenta. I am the CEO of Busy Brain Training and Consultancy and also the CEO of Influential Women of Substance. And with me is Christiana Deyo Layeni, who will be taking us through this webinar, but I'm going to leave her to introduce herself better, please. Thank you.
My name is Christiana. I work in finance. So I have over 6 to 7 years of experience in finance. I started off with audit. I have in-depth industry knowledge in telecoms, real estate, media advertising, and currently I work in PR as a senior finance manager at Black House Media Limited.
Thank you very much. Thank you for introducing yourself. So that means you got a lot of experience for us. Now, I'm going to start with the first question I have for you this morning. It says, how do you fund or finance a business? Someone looking to start up a business financing. So what are they going to do? How do they do that, please?
Businesses are financed through debt and or equity. So what do I mean? Debt could be long-term, could be short-term. Short-term debts is basically for your working capital, something to help you sustain the business operations. Long-term debt is more of your bonds, your debenture, something that can help you acquire new assets, invest in other projects, acquire new businesses. That's more of a long-term stake. Now, when it comes to equity, you're looking at things like your retained earnings, you're looking at your reserves, you're looking at your share capital. Could it be ordinary share? Could it be preference shares? So those two things are the things you use to fund your business. Now, there are different scenarios on how you fund your business. You could have a significant portion of your business made up of debt and a smaller portion made up of equity. In that kind of situation, they'll say you are highly geared. Where you have a significant portion of your company's finance funded by equity and a lower portion funded by debt, maybe 80% equity, 20% debt, you say that's lowly geared. Then where you have it to be solely equity, maybe you've brought in all your own money into the business and then the money you've been able to retain from the activities of business over time, you would call that an ungeared company because you're relying on just what belongs to the business, just your money in the business.
Okay.
So that's ungeared.
All right. So you're talking about debt. So how would you describe that? So people, obviously, when you say debt to people, they will think is kind of like owing money or something like that. So how would you kind of explain that to people? So what would you say about that? What should we consider before taking a debt financing? What should we think about before going into that?
Before taking a debt financing,
yeah,
I would say that there are key things you need to look into.
Okay.
First of all, how much is the money you're looking at?
Okay.
You want to also look at the tenure of that. How long do you need the money for? Okay. You want to look at what the interest rate is. What is the rate that your bank A option, bank B option, bank C option, your private equity options are providing you? You want to look at the interest rate they're providing. Now, when you've looked at how much you want to collect, what the interest rate looks like, how long you need the money for, you begin to now look inward at what do I want to spend this money I'm collecting on? So what are you spending the money on? When you figure out what you're spending the money on, you do a financial viability of that particular investment. When I put this loan money into this, what kind of, am I getting returns on this investment? The returns on this investment, is it economically viable for me? Like, for instance, I'm going to take a loan and the interest on the loan is saying 10%. And the return on investment on that particular investment I want to take the loan for is 5%. It doesn't make any economic sense to take that loan because I'm not even going to make the interest cost of that loan back from that investment.
Okay.
So you want to look at all of that. So you want to make sure that that investment is economically viable for you. Then finally, you want to make sure that the returns on that investment aligns with the loan repayment period. Okay. Meaning that if you're taking a loan for an investment of 5 years, you want to make sure that that 5-year time when you want to start paying the loan back, or if you have to start paying from year one, you want to make sure that the investment you're taking that loan for has started yielding some kind of return enough to pay back for the loan as at that time. So it's not that when it's time to pay the loan, you're having cash flow problems or difficulty in paying the loan because you have not been able to plan the money to pay back. You're collecting the money in advance. You have to pay back the person you collected the money from. So you have to be able to make sure that you align the returns from that investment to the loan repayment. So those are the things you should consider.
Oh, that's good. Oh, so, and I was a bit scared, like sometimes people want to start businesses and they're afraid of going for loans. So actually, this has actually explained that we can still go for loans to start businesses and still profit on it. Oh, that's good. Another question I have for you: what do you mean by credit and external financing? What do you mean by that? Explain to us what you mean by that, please.
So let's say credit is an obligation for goods and or service rendered, which it happens between two or more parties with an intention to pay back in future. In simple terms, I want to buy rice for Christmas, or last year Christmas, I bought maybe 20 bags of rice. I spoke to the vendor. I told the person I would pay you January 2022 for the rice. I have collected the rice. That transaction is over, but I am to pay that vendor in January. That's a credit, meaning that I have taken something now, enjoy the service now to pay at a later date. Okay. Now, when you're looking at external financing involves how you finance your business, how you fund a business outside of what the business has been able to generate by itself. The equity options, there are plenty of options for you. So you're looking at commercial papers, invoice discounting, you're looking at right issue, anything that can bring in money from outside into the business to grow the business.
Okay. All right. So basically, it's what you get from outside, just put into your business to make the business successful. Is that what you're trying to say?
Yes.
And it doesn't matter how or where you get it from. So it can be loans, it can be your personal money, it can be credit from the vendors and all that. So that's what you're trying to say?
Yes.
Okay, thank you. That is good. And thank you very much. Next question for you is, how do businesses leverage on debt for growth?
Let's use the first case study.
Okay.
Christiana and Co. I'm the MD of Christiana and Co. I make key holders. Yes, I make key holders. That's what my business is into. Bukola and Danladi, a different company that supply key holders to maybe they export key holders, let's say, when we imagine. They walk up to Christiana and Co. and say they need 100,000 key holders. I look inward and I realize that I don't have, so I have the machinery, the infrastructure required to produce the key holders. Fantastic. I also have electricity, I have diesel. Amazing. Everything required on the operations end to reach the employees, I have them available. However, the inventory required to produce that product, I don't have it at the moment. So maybe the key inventory could be plastic or steel. I don't have it at the moment. And I need to buy it, but I don't have money. So there are plenty of options for me. The first option is to tell Bukola and Danladi, sorry, I don't have the inventory required, so I cannot do your business. That's not a business person's mentality.
Exactly.
I could first say, Bukola and Danladi, I want to produce this product for you. I would like you to pay me in advance for it. Bukola and Danladi, all good and fine, can pay me in advance or say no to it. They can say, no, I've not done business with you before. I can't pay you for a service I'm not so certain about. That's good. I go back and look at the business that Bukola and Danladi have brought to me. What I need to get the products that's going to finalize their order is 100,000 naira. That's how much I need to get that inventory. If I finalize their order, I've seen that the profitability for me is about 45% of that money. So it means that when I finalize their order, that sale would be 145,000 naira coming to me. And then Bukola and Danladi have said, if you can produce this product in 2 weeks, we pay you in another 2 weeks, meaning that I have 4 weeks to collect money. I can now go and say, I meet up with an investment bank, I meet up with a regular bank, I meet up with a microfinance and tell them, I need 100,000 naira to pay in 1 month time. What is your interest rate? They tell me 5%, 10%. I look at 10% interest to get 45% more. Makes a lot of sense to me. I agree with them. I sign the papers. They give me the money. So meaning that now I do not have money to produce Bukola and Danladi's product, but I have collected money from a microfinance bank to produce that product. I finish producing the product. I give it to Bukola and Danladi. They pay me my money, 145,000 naira that has been agreed. I go back to the microfinance bank. I pay them 100,000 naira, that is the principal I borrowed from them, and the 10,000 naira, that is the interest for them. When you net off the 110 from the 145,000, that was total sales on that, I have been able to retain 35,000 into my business. That's new cash flow.
Okay.
Money that I can use for my operations, money that I can use to buy more inventory, money that I can use for working capital requirements. Okay. Now, that's one option there. And what have I been able to successfully do with that option? I have been able to increase my sales. At the bottom end, I've been able to increase my profitability.
Okay.
Another option is, another example, another case study is, I want to build a factory. Maybe I realized that there's a need for a shea butter producing factory or refining factory in Osun State. And I look and I run the numbers. I do my feasibility study. I do the projections for what cash flows will look like. And I realized that to set up the plant at Osun State would take me, let's say, 10 million naira. But currently, if I take out 10 million naira from this business that I am running, it's going to impact on my current business. So I can decide to say, I would only take 2 million naira from my business. I'm going to go and take 80% of that money from another person. I meet up with a bank. I meet up with an investment company. There's so many of them these days. You have cash vans. There are plenty of them in Lagos and Nigeria. I look at one of them and I tell them, this is what I intend to do. It's a 5-year project. This is how much I need. And they're like, oh, that's fine. We can provide you that. They bring in the money, then I pay them when I have agreed to pay them. What have I successfully done? I've opened a new factory. I've created a new branch on other people's money. And when I'm done paying them back, I still have my business. I never also lost control of my business while that business was ongoing.
There's something I picked up from what you were saying. You were talking about when you go and go to the investors and you get some money from them to help you with setting up a new business. Now, what of people who don't have prior or existing businesses prior to starting that? They want to this is their first businesses. How would they be able to obtain these finances? Because remember, this is someone that is fresh in the business industry who wants to start up a business, but obviously need the finances, need to get the loan or whatever it is, whether it's a debt or however it is, just to finance the business. How would they go about it? Because what all the case studies you've given us here is basically about people who already own businesses. So you already have something going to get something new. And obviously you have the collateral to be able to go into something new. So how would you, as a new business owner, get all these finances you're talking about?
For a new business owner, in as much as you do not have the advantage of an existing business that can show that is credit worthy, for a new business owner, on a personal place, now it's your person that proves credit worthiness. To start up that business, you want to look at your equity. You want to look at what exactly you have at hand to start your business. How much do you have? You also want to look at your immediate circle of family and friends. How much can they bring in to take some percentage shareholding? You also want to look at how you can get personal retail loans, Banks here in Nigeria provide that. Guarantee Trust Bank, Access Bank, Fidelity, they provide that. You want to look at how much you can also get on a personal level to start up that business. So you take a mix of all of that and put it together to start up your business. So you will not be able to get loan on behalf of your company because there's no track record that your company is even going to make profit or your company exists, first of all. However, there is a track record for you as a person that you are creditworthy.
Okay.
A good character, that you have some sort of income. Now, is that track record you would use to get loans on a personal level that you bring into the business? So you get personal retail loans and bring into the business.
Okay, thank you. That was well explained. Thank you. Welcome, Yami. Welcome to the show. We're waiting for you.
Thank you very much, Fiona.
Welcome. First of all, before we go on, thanks, Dayo, for explanating. I'm going to go to Yami for a brief introduction of himself, what he does, and where he's coming from, please.
All right. Thank you very much, and thank you everyone that has joined. Thank you for having me as well. I'm the Chief Product Officer for Parkway. I've worked in Parkway for a number of years, managing products basically, and I've been around the financial ecosystem as well for some time. I've worked in 2 banks, and I've also worked with the Central Switch in Nigeria. And speaking to what Parkway is later on, but that's basically what I do.
Okay. All right. Thank you very much. Before you move, I want you to actually tell us briefly what is, because you just mentioned this, so you might as well just tell us what they do, really.
Awesome. Thank you very much. So Parkway is one of the indigenous financial service providers in Nigeria. We've been around for about 17 years. We were incorporated in 2004, and it was initially set up to build financial services for banks and the early day fintech at the time, or early day switches in Nigeria at the time. Parkway has been responsible for rendering business solutions to these corporates or these banks at the time in a project-led manner. And recently, we are led company. Parkway has been churning out products for business directly, and now it has deemed it fit to also churn out products to customers directly. Some of its products includes its corporate payments product and collection product called Bank 3D Corporate. It also has a Bank 3D retail solution that optimizes payment experience for businesses through bank transfers. It has a payment gateway as well, so online merchants can also receive payment through Bank 3D's payment gateway. The company also prides itself in the ownership of a mobile money solution called ReadyCash, used to receive or used to power agency banking on the retail front for agents. As I said, Parkway also prides itself in the ownership of an agency banking solution called ReadyCash. Parkway's ReadyCash has also been able to power hospital collections and other close payment collections in the payments ecosystem. Parkway has been around for this long, and one of the major things that we've been doing is to drive innovation. It has been a major factor for us. In fact, there's virtually no payment solution you have in the space today that has, in one way or the other, not been conceptualized or built by us and kept in our repository at some point or the other over our 17 years of experience. One of the things that we intend to do as we go into the future is to enable businesses or enable fintechs and startups to be able to leverage or get into this payments ecosystem in an easier and a faster way. That's it about Parkway.
All right, thank you. I would come back to you. Let me just process what you just said. All right, back to you, Christiana. I need to make money. That's why I'm always coming to you. Don't worry. So I need to know everything I need to know just to get more money for my business,
That's
all right. So a few more questions I have for you. I just need you to clarify these things. Why are more entrepreneurs opting for debt financing to grow their businesses? So why are people going into that more?
Let's start with the cost. The cost of debt is relatively cheaper than the cost of equity. Both debt and equity finance come at a cost. Equity comes with you paying dividends. You're going to constantly pay dividends till your shareholders, till they decide to stop being your shareholders, or your business decides to stop operating. While for debt, your cost of debt is only tied to the tenure of the debt.
Okay.
So if you take a loan for 5 years, your cost is only tied to that 5-year period. You're not going to pay you're not going to pay the lender any money back after you've paid him all his money.
Okay.
So the first thing is the cost of debt. Secondly, you're looking at accessibility. In 24 hours over here in Nigeria, you can get a business loan.
All right.
So I need money to quickly deliver goods and service. I need money for quick working capital funding. I can get that in 24 hours from a lot of microfinance banks and investment banking firms out there in Nigeria today. We have people like Stenic, Cashvans, Lendigo providing you these things in 24 hours, Red Money providing you this in 24 hours. Now, if I decide to go to a regular banking system, I can work within 72 hours to 7 days to still get that money. If I was to have gone for equity, it means I first have to go and look for shareholders from somewhere. I have to now find a way to register them with the Corporate Affairs Commission. That's a long period. I'm getting that money. I'm sure I've gotten the money. I've forgotten I collected the money because I've used the money while I'm still trying to assess myself to get an equity person. So accessibility is one other reason why people are quick to adopt debt financing. Another thing is control. I know that with debt financing, certain lenders would give you restrictive covenants that maybe your debt to equity mix should retain at a particular level, or you cannot take additional loans while working with us. But those are just the only restrictive covenants, the tenure of the loan. They can't tell you how to run your business after the loan is over. However, with equity, if you had gone for that option, you would have required your control will be shared between you and the shareholders.
Okay.
In short, in some situations, the person that has the largest share might be the guy that calls the shots. So you retain as much control as you want for the business to make the right decisions for itself when you obtain debts. Because it's a simple thing as, I only collected money from you and it's now left to me to make sure I pay your money back however I want to get money out to I pay you back. So that's what it is. You're looking at control, accessibility, you're looking at cost. Another interesting part is that you get tax savings.
Okay. Really?
Yes, you do. So you get tax savings on interest. Let's say you want to file you finished your January to December account and you want to file it. You've been able to take 1 or 2 loans during the past year. Just as capital allowance, that's the assets you had acquired during the year. Those ones are captured under capital allowance. Gives you some kind of deduction from your taxes. Now, your interest costs also gives you some kind of deductions on your tax payable. So that further reduces how much you are to pay. Since you have been able to show that, yes, I have incurred some interest costs in me trying to develop or expand this business, the government is like, we agree with you. Take this percentage out of the money back as yourself. So you have that money sitting back with you. That's another good thing about. And then it provides you working capital like you already know. It can allow you to dream big, can allow you to acquire any business. It can allow you to start up a new factory. It can allow you to do new infrastructure investment because you have the capital to do it. That's why it's really attractive to entrepreneurs.
What would you consider before going into that? So before going to take out the debt financing, what would you consider? What would you think about before going into it?
How much do you need?
What if that amount is not enough for you? So for example, if you're thinking, okay, let me go for £10,000, example, and you that is what you did the costing and everything, you came up with that amount of money. But come to think of it, as you want to go for it, it's not, and you come and find out it's not enough. Would you go back, or how would you do it?
Let's say you're taking a loan to finance a particular project and you realize that loan is not enough for that project. You can either go back to that lender and tell them, I want to top up With your top-up loan, you can also restructure the terms. You can decide not to go back to that lender. You can go to a different lender and tell them, I want you to come in to this business. I need extra money. But this time around, I don't want to just collect loan. You know what? Give me certain loan, and also I'll give you an option of converting it to equity in the future. It's left to you. So you could top up, or you meet new lenders and take money from them, conversion and things like that.
I'm sorry. I just went over. The first question was, what do you consider? Sorry, that came into my head and I just had to button it there. So what would you consider? You were about to say something else before that question just came and I had to say it. All right, so go on. So what do you consider? Sorry.
It's fine. I'm sure somebody on our talk needs it today. What do you consider? You consider how much you need.
Okay.
You consider what the interest rate is. I always advise people as a finance person, I never stop with one option. So I check out up to 2-3 options from banks, investment houses. I check out what they have to offer me as per interest rate. So you want to check what the interest rate is. And thirdly, you want to check the tenure of the loan. So how much do you need? What's the interest on it? How long do you need the money for? When you get all of that, what exactly, you know how much you need, but what do you need it for? What you need it for, you've been able to determine what that proposed investment is. Now, your proposed investment, is it bringing returns on it? What's the return on the investment? Not that you go and take a loan that the interest is saying 10% or 20% and the return on investment is saying 8%. What covers for the shortfall?
Okay.
So you want to make sure that your return on investment is actually economically viable. It's a good economic decision. Mm-hmm. I would always advise that your return on investment should be more than how much interest you have to pay on the loan. So make some margin on that return on investment. Then finally, you want to make sure that the return on investment, you can align it back to your payment days to the loan. You've collected money, let's say for instance, I've collected working capital loan from a bank in Nigeria, and I've told them I need this loan for 6 months. I've decided to be paying them back every month a particular percentage of the money.
Okay.
From that project I'm working on, so that when I need to pay the money is readily available to pay it. Not that I need to pay the money, I'm having high blood pressure because I don't know where I'll find the money from. So those are things you need to consider. Align your return on investment with the loan repayment.
So let's say, like you said, 22nd of every month, and something happened in that month, and you're not able to pay that money on the 22nd of that month. So what do you do in terms of that? Because a lot of people tend to get scared, panic, and don't know what to do. And because it's a loan, you tend to be afraid of what's going to happen. For example, I'm talking about the UK. When you go and take a loan and the day comes and you're not able to pay it back, it's like all the emotions that's happening to you. But, I don't know how we can cover it up. So how do you do that, please? Can you explain that for us?
You will tell him, I pay you in 45 days, or I will pay you in 60 days, 90 days. In Nigeria, you even have some organizations that pay in 120 days. That's the easiest one. Meet a supplier, agree credit terms with him. That's the very easy, and that doesn't even come at a cost.
Okay.
You just have to be credit worthy. That's all that is required. Now, the second thing you can do is you can decide that I have sold my products. This is called invoice discounting. I have sold my products to company A, B, C, D. They are yet to pay me money because based on the sales term with them on our contract, they have to pay me in 30 days or 60 days. I need money today. 60 days is a long time away. I will take those invoices together. I can take them to the bank. I can take them to the different lending houses we have. That's what I've been mentioning. If you notice, I keep calling different lending houses because I don't want to limit people's options to just banks. Okay. Or I can take them to a microfinance. I'll say, these are all my invoices. I need you to pay me 50% of the total amount on these invoices. Or I need you to pay me 70% of the total amount of these invoices. How much is the interest you're charging on it for yourself? Good. Now, what they do is when these clients pay, they take back their own principal plus interest and leave me the balance on the money. What have I done? I have successfully been able to get money in advance for products I've supplied. And then when the money comes back, the owner of the money can collect it back because now the lender is the owner of the money. But me, I've been able to successfully get money. So that's invoice discounting. Another thing you could still do, still looking at sales, is that I know a lot of businesses these days sign contracts with their clients. Like most times this happens with service providers. So if you're providing service, I know you probably have signed a 1-year contract with your clients, or you've signed maybe a 6-month contract. Based on what your trend analysis is or what your projections for the business you want to do with that person is for that year, you can look at, in the next 3 months, I know that between both parties, between me and you, I can supply you products or services worth 35 million naira.
Okay.
Now, what I need you to do is pay me 25 million naira now and get 10%. That's 10 million naira as your discount on it. I will still supply you 35 million naira in 3 months for the 25 million you've paid me now. That is referred to as volume discounting. So all you're just doing is you're meeting your clients and telling them that as their supplier, you're willing to supply them. They should just pay you in advance and you're willing to provide them a discount on that advance. So far that client has that capacity for it, they will be willing to take it because it saves them costs. For them, it's cost savings.
Okay.
But for you, it is working capital because now it gives you the ability to do more. Purchase. Now, that's on your business sales level. Now, let's take it up a notch. You're looking at other kinds of forms of working capital. You can decide to do commercial papers. People think that you have to be a PLC to do commercial papers. That's a very, very wrong opinion. An SME can issue commercial papers. All you need is an investment house. Meet with a Stenic, for instance. Put your financial records together. Let people see that this is the projections on the profitability they can make from you. This is what you yourself look at as cash flows for your business in the next 6 months or 8 months or 12 months. And this is how much you need from them. They should come and buy your commercial papers, issue it. They would sell it for you and you get money now. And the good thing with the commercial paper is you would pay them at the end of the tenure. So let's say you take 50 million now for 6 months. You will pay them back 50 million plus maybe the 10% on it at the end of the 6-month period. Now, if you decide not to use commercial paper, you can go for a term loan. A term loan can be 30 days, can be 60 days, can be 90 days, can be 1 year, can be 5 years. You just have to find the one that works for you, the tenure that works for you. If you don't want to go for a term loan option, don't worry. There is something that the banks in Nigeria are currently offering. It's called a retail loan. If your business page has an internet banking platform with GTB, the GTB gaps on it, you would see retail loan available there. Now, if you don't use GTB, you use Access, you use Zenith, you use other banks, Fidelity, anyone. Call your account officer. I need a retail loan. Retail loans run for 12 months. I need a retail loan of 10 million naira. Some banks give as much as 20 million naira. Some banks do 5 million naira. I need 10 million naira from you guys as a retail loan. In the next 12 months, it will be paid off. So every month you're paying maybe like 920,000 every month. You don't feel the impact as much on your cash flows because that's all you're coughing out every month till the 12 months is over. And the good thing is you can either tell them you want to go back and take another one, or you can say, oh, my business with you is over. Thank you and good day. Now, if you decide that you don't want to take a retail loan because what you're looking for is not a short-term investment, maybe now what you're looking for is more long-term for you. You can decide to issue bonds or debenture. People still think these things are limited to just limited liability, to just PLCs. No, limited liabilities can also do this on their projects. If you have a project that looks like it's going to make money for you, and you've run the numbers and you've been prudent when running the numbers, not you've overestimated or you've been elaborate about it. When you're running numbers, please be prudent.
Okay.
You've been as prudent as possible with the numbers you've run, and you see that yes, this thing still makes sense.
Okay. Thank you. I need to just interrupt you there. I've got a question from Peter again. Peter has asked us, it says, how do you evaluate a business for healthy repayment in order to guide against bad loan? So how do you evaluate a business for healthy repayment?
Let's say I sell goods and services, or I'm a service provider. I need 20 million into my business today. I have been able to find someone to give me the 20 million. The next thing now I look at is, what are my sales looking like? What's my sales forecast looking like? These people I'm selling to cash, the people I'm selling to on credit, how long is their credit term looking like? Is it 30 days? Is it 45? You want to take all of that into consideration. Now, what you want to do is, I'll give you like a simple loan structure, a repayment structure for yourself in-house. So you've taken 10 million naira, for instance, and you need to pay back in 6 months. You've put out all your customer lists and the different contracts they have with you and the different ways they would pay you. So maybe you have a retainer customer, fantastic. If you don't have a retainer customer, it's all good and so. You know that this person will buy from you 20,000 bags a month, or you provide service worth 200,000 to this person a month. The person is to pay you on the 23rd. You put that person's name as part of those that you used to pay on a monthly basis. Now, for a guy that pays you in 45 days, you put in as part of the name of those you want to put every 60 days. So what you have now done is, the guy that pays you every month, you put him towards a month end, but make sure that he's not paying you at month end, he's paying you before month end. Now, the guy that pays you a longer period, put him in 2 months. So that means it's not in your first month plan for repayment, but it's in your second month plan for repayment. Because I understand that cash flows are not static. Cash flows move in different ways. So you want to put that guy as the guy you used to pay for your second repayment. Now, there's a guy that has agreed with you that he will pay you in 90 days. That guy, use him as your fourth repayment. Don't use him as your third, because 90 days you can come and say, I did not make money in my business, so I cannot afford to pay you. Put him as your fourth, because you now have money down before it. If he pays you on time, good, you can use him as your third. If he doesn't, the fourth is still sitting down there for him. So what you do is just structure your receivables. That's what you're going to do. All your receivables, highlight them and structure them to how much you want to pay each person and when you're paying them. So you structure your receivables to be able to pay back the loan you have taken.
Thank you very much. Peter, I believe that answered your question. I did answer the question for me. So I guess that is a good enough way for doing that. Thank you. Thank you very much, Daggy. Anyway, I think our time is almost coming to an end. And I think we've done justice to some extent to this. And I really want us to continue this in another series because I kind of enjoyed it. Parkway, I'm going to come to you soon and you explain to us a lot more about your products. Maybe choose one, just finally before we finish, choose one product that you think that you kind of like, that you think businesses out there would benefit from solely, like will make a huge difference to them in their business. So I want you to just choose one And I'm not calling you Parkway. I know you mean, don't mind me because you work for Parkway, so I kind of like calling you Parkway. So choose one solid product and kind of like round up for us with that, please. Thank you.
Awesome. Thanks, Fiona, and thanks, Dejo, for a very, very fantastic job. In fact, at some points, I didn't want that to stop because I was just enjoying what you were saying, and I was taking learning from it as well. So for me, that one product is Bank3D, and if you look at the that's what we're using to sponsor this event as well. And it also ties into what Dejo has talked about around collection of loans, because you have to pay that loan. Now, if you have a solution that helps you to ensure that your transactions grow, that you have more to be able to grow your business, why won't you take it? You also want to be able to show the bank that, hey, you have that capacity that is required in qualifying you for that loan. Customers walk to your business location, elect to pay with bank transfers, and boom, they can, without any friction. As soon as that payment has been made, your cashier confirms it on his or her own, without recourse to the store owner. And you begin to see the growth. And the interesting thing is, it can be in anywhere in the world to monitor your transaction. If you are looking for how we intend to provide this solution to the cashier, you can basically have a computer and access the Bank3D app online, or use a mobile phone and download the Bank3D mobile app to access the solution. The solution is very, very easy to use, and we've seen tremendous changes in the way in the lives of the customers that we see use the platform today. So that's the product. Bank3D is a major product.
Thank you so much. Thank you. Any more questions from the floor? Thank you so much. I'm gonna actually look into the Bank3D. And thank you, Dejo, for your teaching, I would say, for your lecturing, I'll call it, for your everything. I'm gonna come to you. Don't worry, I'm gonna come to you to have lectures. I'm gonna sit down. I don't mind. I'm gonna set the Zoom link to, even if it's 10 hours, I don't mind. Because I picked up quite a few things, and I did pick up something from this one today. And then I hope to see you guys again, and I hope to do business with you guys pretty soon. So thank you. Any more questions? I don't think there's any more questions. I don't think we'll have any. They said they want to see you again, Christine. They said they want to see you again. The audience is saying you will definitely. I'm sure you will see her. Somebody, Chidi, said he wants to see you again. I told you that you did justice to the topic, really. So we picked up so many things from there. So
thank you very much, everyone.
We'll be back, definitely. Chidi will be back. Trust me. In a few weeks' time, you'll see us back. Thank you.